Hi class, welcome to Chapter 7, Valuation of the individual firm. Alright, this chapter is going to be a little bit more complicated. There's a lot more calculations in this chapter. I'm going to try to go through it at a good pace, and I will be happy to take any questions on the message boards or an email. Okay, some objectives here. Understand the basic valuation process as it relates to earnings and dividends. So, I'll talk about this later, but I'll give you a sneak preview right now. When we buy stock, what are we buying, right? Well, we're buying ownership of a firm, right? What else are we doing? We're actually also buying a piece of their future earnings. That's a good way to think about owning a company as a stock from an investment perspective. Explain the related concepts of risk and return, okay? Be able to use various present value oriented valuation models. Describe the role of the price to earnings ratio in determining value. Goes back to what I said a second ago. You're buying a piece of future earnings. Explain how an individual stock price to earnings ratio is related to the market. Okay. Explain techniques for forecasting earnings per share. So we have some basic valuation concepts. Dividend valuation model. Based on future dividends. One underlying concept behind valuing any stream of future income is to think about it. It's doing present value calculations, which we'll talk about later. It's almost like the reverse of compounding. So what's $100 a year from now worth today? How would you calculate that? Well, there are calculations that we can use based on estimates of risk and future inflation and interest rate to help determine, what a fair value of $100 a year from now is worth today. Okay, there's earnings valuation models based on ratios, earnings multiples, long-run historical relationships, market price to sales per share, and market price to book value per share. Market value of of assets, including cash, liquid assets, replacement value, hidden assets, etc. Okay, risk and required return concepts. So the required rate of return is the rate at which future cash flows are discounted to reach a valuation. Investor must know the required rate of return on the various risk classes. The higher the risk, the higher the required rate of return. Right? That makes sense. Does that mean we're always going to have more risk will give us more money? No, but what it means is that a higher risk has a higher potential payoff. But it would face, all things being equal, similar downsides as well. The capital asset pricing model, or as it's referred to, the CAPM model, CAPM, determines the required rate of return when valuing stocks in a diversified portfolio. Okay, next slide. So adding a risk component to the risk-free rate. Okay, so we have the risk-free rate there, which is RF. We have the beta, right? The beta is the, what is beta? That's actually a great question. What is beta? Think about that. So it's something that you'll often read about in finance, but you should have a good understanding of what beta is. Well, beta measures the individual company risk against the market risk, and what that formula is, it's covariance over variance of the market. Okay, but you will not need to calculate that here. KM is the expected return for common stocks in the market, and RF, again, is the equity risk premium. So what are we doing here? What is this formula? How do we use it? Well, RF would be the risk-free rate. Then it would be adding the multiplication of the beta multiplied by the difference between the market rate and the risk-free rate. What's the excess return? So it's really the beta multiplied by the excess return from the market versus the risk-free rate. So pretty easy calculation. Okay. Risk-free rate is a function of both the real rate of return and an inflation premium. So it accounts for the real rate and inflation. And normally, I think a lot of you would tend to do what I used to do, is like, oh, we add them. We add the real rate, and then we have the rate of inflation. No, we don't add them. The formula to come up with the risk-free rate is 1 plus the real rate multiplied by 1 plus the expected rate of inflation. When we do that, we'll get like, it could be like, whatever we calculate. It could be like 1.03. But that's why we have the minus 1 there. So then the rate of inflation is 0.03. So that's why that's there. Normally assumed to be the return of the U.S. Treasury security. So the UST Treasury securities are the closest thing we have to a risk-free rate. So that's what pretty much the entire world uses as their risk-free rate. Okay. Beta measures individual company risk against the market. Okay. If a beta is beta is greater than 1, it has more risk than the market, meaning it's a more volatile stock. Beta is less than 1, it's less risky than the market. So let's say you were, you think the stock market's going to do poorly, you want to buy a defensive stock, you might have like a low beta strategy where, if the market goes up 5%, a low beta stock might only change by 1%, and the reason for that is that it's less correlated with the market, right? Beta equals 1, right? It'll have the same risk as the market, meaning generally when the market goes up 2%, the stock tends to follow the market, okay? And another key thing here, it is based on historical behavior. It's not forward-looking. So if there's some pivotal event that changes the way finance works, which can happen from time to time, based on, regulation or the economy or a bunch of other stuff. It's more relevant for a portfolio of stocks, too. Okay. The equity risk premium, that excess return I was talking about in the last slide, it's not readily observable. It's based on expectations, and it changes with people's level of risk. If you're more risk adverse, you might be more conservative, etc. It represents the extra premium the stock market must provide to investors compared with the UST bill, right? So we have the general dividend model, constant growth model, non-constant growth model, combined dividends and earnings model. So these are just some basic valuation techniques. I say basic, but if this is your first time using them, they might seem a little complicated. But nothing more than basic algebra here. Okay. So general dividend model. So what this is doing, right? See, we have D2. So there's one of the numbers here is grayed out for some reason, but it's actually D1 over 1 plus K, right? So that would be $1, right, over 1 plus K over E, which would be the risk-free rate. Okay, going back, they use it differently there. So the second year, it's 1 plus K squared. The third year, it's 1 plus K to the third. So what is it doing? It's compounding the interest rates. We're dividing our dividend by the denominator in order to get a good calculation for what that dollar is worth today. So we're discounting that dollar back to today's value. Whether it's $1 or $100 doesn't matter. That's what all these models primarily do. They're all discounting models. Okay. Constant growth model. So very similar to the last slide. The only difference between this one and the next one is that this model accounts for a constant growth in the dividend. And some companies, larger companies with excess cash have been known to, increase dividends by 5% a year, every year. And that would be a perfect candidate for a constant growth model. Okay? So here's some more details there, but more or less the same concepts here, except we're just accounting for growth in the dividend year after year. Okay. Constant growth model. Constant growth model is actually really easy in terms of a setup. Okay? It is the dividend, right? If the dividend is going to remain the same, constant, right? It's not going to change. Over the required rate of return minus G, which is the growth, right? So required rate of return minus growth, the excess return over that, over the dividend 1 period from now. That's what D1 means. If it was D0, you'd know it would be today's dividend. D1 means the dividend a year from now. But that's what most of these formulas generally start, because you're looking at your next dividend, right? Okay, so here's just giving a little equation, an example. Okay, so we see the dividend right there is $3.38 over 0.12 minus 0.08. Okay, very simple, very straightforward. You know, and this isn't any different than doing the calculations for the other dividend models we showed you. They're just going out further and further. We'd have a plus sign here, and this might be 3.38 over 0.12 minus 0.08 to the second power, you know, when you're adding all that in. You know, that would be, you know, a dividend 2 periods from now. Okay, so it's showing the calculation there. Non-constant growth model, you will combine, easiest way to explain this, go back. When you have a non-constant growth model, you might have it set up like this first. You know, the dividends just, you know, increase period to period. But then at some point, maybe 10 years from now, you start hitting growth. For some reason, who knows why you forecasted this to happen with this company, but you're saying, all right, it's going to remain stable for 5 years. After 5 years, the dividend is going to grow by 5% a year. You know, and then you would basically merge those two formulas in order to get a non-constant, you know, dividend growth model. Okay, it gives you know, the first, you know, it's basically going here 8% after 11 years. 20% for the first 10 years, dividends per share. So we have to calculate that. Okay. Combined dividend and earnings model. So earnings per share. It's giving all earnings, dividend and regular earnings. And then price to earnings is an earnings multiplier. It's also called the PE ratio. Analysis of a company growth. Sustainable growth model, okay, examines the growth of a firm, can generate by maintaining the same financial relationships year after year. Okay, provides insights into the financial interactions. It requires understanding of several ratios. All right. So, return on equity, okay, is net income or after-tax earnings over book value. Okay. Then on a per share basis, return on equity is earnings per share over book value per share, right? We're making that more miniature, you know, the way we look at it. And then retention ratio. The retention ratio is if we have an extra $100 in cash at the end of the year and we pay 60% of that out in dividends, our retention where we're reinvesting, hopefully, back into the company is our retention ratio. Okay. So, sustainable growth model, growth in EPS, return on equity times retention ratio. So that's our calculation to get G. Remember that little G from way back here? The calculation for G is this, right? That's how we get return on equity times the retention ratio. Retention ratio is capital B. The lowercase b is beta. Now, don't get worried. I'm going to ask you more on concepts than the formulas. But I would maybe expect to see a formula on a quiz. Additionally, if you can get a solid understanding of this, you can, I would recommend looking into getting your CFA. The CFA is, as I mentioned maybe earlier, is a very well-respected, and highly valued credential in the financial world. If you have your CFA, a lot of doors will open for you. So these are the concepts that are, talked about, and the ones you're questioned on during the first examination for that. Anyway, I don't want to go off on too much of a rant, so we'll continue. Return on equity. So we're seeing excuse me, sorry, I forgot. We're seeing the earnings per share over the book value per share, right? To get the ROE. So earnings per share over book value per share. So So what is that really breaking it down to? What we're bringing in per unit of the company. To forecast earnings per share, we look at the process of growth on a per share basis. So they're saying EPS, right, for 2012 is going to be 18.63% times 644, because that's what we're considering our return every year. Sustainable growth model. The firm paid out a dividend of 38 cents in 2011 and retained earnings of 82 cents. Okay? So what is it giving us right there? It's giving us the retention ratio, right? 38 over, 82 over 120 would actually give us a retention ratio. The 82 cents gets added back to the beginning book value per share to get an ending book value per share of 726, right? So that 82 cents, that retained, gets kicked back into book value per share, right? So now it's saying book value per share in 2011, because of the retention, was at $7.26. If the firm can continue to earn 18.63% on equity, its earnings will be $1.35 per share in 2012. How is it doing that? Well, 18.63 times 726 to give us the earnings per share. So this is how all these calculations are used. I will tell you, most of you, even if you pursue a career in finance, don't get scared. I can tell you I've done those calculations probably less than 3 times professionally. So it's not something to be too concerned about. So, but for school, you'll have to know it. Okay. To grow, the firm must retain some earnings. If it paid out all its earnings in dividends, it would start each year with the same book value per share, and the firm would not grow. The more earnings retained, the higher the growth rate will be, right? And this is a lot of theory, right? But sometimes companies don't pay dividends when they should, and some companies pay more of a dividend than they can afford. And there's reasons investment-wise, that's good and bad. Like for example, we have a company that's paying a high dividend, and they really can't afford it anymore, but they continue to pay it. Why do they continue to pay it? Well, because of a lot of these valuations, right? If they drop the dividend per share, what would happen? The expectation would be, that you're going to get less future earnings. All those calculations would be thrown off, because instead of getting $1.10 a quarter, now you're only getting 90 cents. So that changes things. Okay. If the firm retained 82 cents out of 120, I'll let you read this on your own. I won't read it to you. But it's giving you some more ratios here. Be sure to pay attention to these. Ask questions if you have any. There might be a small calculation on the quiz. In assessing the worth of an investment, the term growth stock is used by stockholders, analysts, and investors. There's a big difference between a growth stock and a growth company. A growth company is something that is, expanding, growing, right? But a growth stock is something that you would expect, to increase rapidly, right? Probably not pay dividends because they're a growth stock. Why? Why is growth stocks don't pay dividends? That's because they're reinvesting in all their money. They have a 100% retention ratio. Okay. Common stock of a company growing faster than the economy or the market norm. Predictable earnings growth. Stable. Another key. Companies that exhibit rising returns on assets each year. Sales growing at an increasing rate faster than the economy. Consistently stable with high profits. And usually not as well known as growth stocks, right? Because people don't care about a growth company. They care about a growth stock. They want to know what's going to make them money. Okay. Growth variables, sales income, net income, earnings per share, dividends per share, book value, they're all related, right? They're all related to income and what the company's worth and how much dividends we're paying out, how much we're keeping. The price to earnings ratio mathematically is price per share over earnings per share. Okay? See how it says ultimately the price ratio is set by investors? Okay? Well, That's because the price is set by the market, folks. Okay, and the earnings per share is determined by what, how much money the company brings in. So we're the price over the earnings, right? So if we're bringing in $1 a share, right? Our price per share, our price per dollar of earnings is 7 over 1. If we paid $7 for the share and the earnings were $1, it's pretty, so we're paying $7 today for every dollar of earnings. That's another way to explain that. Moving on, okay. Factors affecting the P/E ratio: expected growth rates, historical analysis, international factors. Basically what this says is anything that can move the stock can affect the P/E ratio, right? Earnings can change, right? People like or hate the product. The price can change based on the value of the stock, based on the demand for stock. Who knows, right? Here's a graph going into detail about inflation and price to earnings ratios. I don't have too many details on this. The book might be able to talk more about this slide. Okay. P/E ratio for individual stocks. The higher their expected growth rate, the higher the P/E ratio, right? So you'd expect like tech firms and things like that to have really high P/E ratios. Not like 1,000,000 high, but like high relative to the market, right? Risk associated with future performance, right? You're going to pay more, right, per dollar of earnings in a risky stock because you expect more in the future, right? Firms with less debt have a higher value in the marketplace. Makes sense, right? You have too much debt. People, just like a person, you might not be able to pay it back. Okay. Dividend policy: low dividends preferred with superior internal reinvestment opportunities, right? So we would rather have a company, especially for a growth company, right, that's not paying dividends. Paying dividends kind of means, well, we don't have anything else to do with this money except give it back to our investors, right? If they were investing in long-term, healthy projects, that could be something that would, be looked at positively, right? Quality of management, quality of earnings, goes into accounting practices. I won't go into accounting fraud right now, but it can be easy to manipulate earnings. Government policy, anything can affect P/E ratio. Here's some P/E ratios of industries, okay, and companies, okay. So low P/E ratio. Let's look at a high P/E ratio. Best Buy, right? Yeah, that was a growing company from, what was this, probably 2000 and 2010. But look at its expected 5-year growth. It's dropping, right? Let's look at another one. eBay, look at that. 10-year past EPS growth rate, 97. It's huge, right? Now it's kind of, 5 expected is going down to, 19. Let's see, is anything doing the opposite trend here? Some reason Duke Energy went from negative to positive. So there's a lot of, Whole Foods is staying fairly stable. Moving on. Okay, P/E ratio for individual stocks. This is just going over some government regulations, So if we have environmental controls, there was pollution control on stocks, and that caused, those stocks to rise. So under Reagan, defense stocks went up, right? Under Bill Clinton, pharmaceutical went down. Why? Because maybe he put, price caps on the product, the regulation that was bad. And then under the other Bush, big increases for defense firms, right? Why there's another war, right? So, just different examples of how P/E ratios can be affected. Okay, so investors and speculators have a short-term view. They ignore present value analysis. Instead, they use EPS and multipliers. They compute estimated values of stock to get, like maybe do some technical trading, things of that nature. Okay, selecting an individual stock's P ratio to the market. So sales per share, dividends per share, cash flow per share, book value per share. When you're comparing all those things in the market, you don't want to be comparing, a Best Buy stock versus the electric company, because they're in two completely different industries. There's two completely different growth models for those industries. You want to compare within a similar industry. Okay, relating individual stocks to the market, P ratio. So we have the stock price, the P ratio of Johnson & Johnson, the P ratio of S&P 500, the overall market. So we get the relative ratio right here would be the company P ratio of the S&P 500, and we'll see where it is relative, basically as a percent of the S&P 500. So if the S&P 500 P ratio was 1 and the company P ratio is 0.5, that would mean the company had a relative P ratio of 50%. Pretty straightforward. Okay. Price to sales ratio is another one. Price to sales ratio can be looked at as a little bit less being able to manipulate, because it's the price of the stock over the sales. It's more difficult to manipulate the sales, right? 58.63 over 17.95. We have the price to sales ratio, and then estimated sales per share, right? And then that gives us our projected price for the next period. Okay. Other valuation models using average price ratios and 10-year averages, price to dividends per share, price to cash flow per share, price to book value per share. These are all used and analyzed the same. Okay. Forecasting earnings per share. Investors get earnings forecasts from brokerage houses, investment advisory firms, financial magazines. They do it themselves. So there's a ton of different forecasts going on all the time. Okay. Forecasting is earnings per share, least squares, trendline method. I won't focus on this for the quiz, but a trend line fitted to a time series regression of historical earnings, which are observations. Okay, a straight line that minimizes the difference between individual observations, and this is a most commonly used method. So we're just trying to project growth using one of these trend lines for growth here. But I wouldn't actually calculate one, just be familiar with the concept of one. Okay, forecasting earnings per share. Cyclical companies can be more sensitive to swings in the economy. So you have to take that into account, right? These valuations and doing these are more complicated than doing one of these formulas. It's almost always a combination of them. Right, cyclical, all right, automobiles. When the economy is doing great, more people buy cars. When the economy stinks, guess what? People buy less cars. Okay, seasonal companies, variability due to seasonal demand, heating fuel, air conditioners, snowmobiles can all have an effect on earnings per share, right? Otherwise, we'd buy pumpkins in September and sell them in October before Halloween. If there was, you could make a big market by that. So that's all accounted for in the earnings per share. Okay, the income statement method. Start with the sales forecast. Create a standardized set of financial statements. Compare historical relationships. So you're going to multiply your income statement by a calculated or estimated growth rate, and then multiply your income by your growth rate. Really pretty straightforward, okay? Assets as a source of stock value. Okay, consider assets as opposed to earnings. Okay, so one company that maybe had a lot of land, you might want to use an asset method for valuing the stock, or partially. You know what I mean? Sometimes you ever heard of a company, the land a company's on is worth more than the company. That can be true, and then you can have a completely different valuation for that organization. Cash, marketable securities, buildings, land, all this stuff. Okay. Natural resources, present value of a future income stream from expected resources. This would obviously be really popular in valuing a gas energy firm that goes out in gas exploration. Let's say they have a 40% chance of finding a new well, and if they find it, there's a 50% chance that it'll have 50 billion gallons of oil. People do the calculations, or should I say, computers do the calculations on that to be able to get to the bottom of it. Okay. Hidden assets, this is the last slide. Assets not readily apparent to investors. can add substantial value to the firm. Assets do not always show up on the books, so you got to be careful there. That's about it. So join the discussion board, do the homework, continue to take the quizzes. If you have any questions at all, always reach out to me. I'm always welcome to take feedback too. If you like something I do about the slides, if you don't, just let me know. Maybe I can change something. All right, enjoy the rest of your week.